What's going on, everybody? Chris here from Project Option. In this video, we're going to explore the long-term performance of put selling strategies on the S&P 500, and we're doing this because the 2009 to 2020 bull market period generated nearly perfect profitability for this options trading strategy of selling naked put options, at least until recently. So in this video, I'm going to perform some back tests, and I'm going to look at the historical performance of selling puts on the S&P 500 index, and we're going to look at how the recent market turmoil affected the strategy's long-term performance. Now, since selling index put options is going to be a strategy that performs well when the index or the product that you're selling the puts on is increasing over time, that is going to be a perfect environment for this strategy. And since the 2008 financial crisis, we've had essentially a straight up market with substantial returns every single year, and that is a perfect environment for selling put options, as those put options will expire worthless month in and month out. But good things come to an end, and in this video I want to answer, how did the strategy perform recently during the initial coronavirus stock market shock? So obviously we saw a very violent down move in the stock market, and the S&P 500 lost 32% at the lows, and I believe the stat was that fall was in 17 trading days, which is an extremely fast market drop and significantly faster than historical drops of that magnitude. So before getting into the put selling performance, I wanted to show a quick chart of the S&P 500 so we can visualize this move against the performance of selling put options on the S&P 500 through this move. So as we can see, in mid-February, the S&P 500 reached its high of about $3,400, and just a month later, it bottomed out at around $2,150 to $2,175, which is a significant drop in just 17 trading days, or a little less than a month. To analyze the performance of selling put options on the S&P 500, I ran a quick back test going from 2007 through the crash of March 2020, and here's how I set this strategy up. The entries I chose were the first trading days of each month since 2007, and for the expiration cycle for these put options, I chose the next standard monthly cycle. So if I'm on January 1st, I'm looking at the standard February monthly cycle, and so on. Now, I tested selling 16 delta and 25 delta puts just to get two levels there, so to speak, and we can compare the profits and the losses in each of those categories. Now, the exits I chose for this strategy were the final trading days of each month. So I entered on the first day of the month, and then I closed on the last day of the month. So each of these short put trades were held for that trading month. And then on the first trading day of the next month, the next trade was initiated. The first management strategy that I tested was no management at all, with the exception of closing on the final trading day of each month. Now, I wanted to show this because I wanted to show the performance of an uninterrupted put selling strategy on the S&P 500. And then I tested the same put selling strategies using a stop loss, so closing the short put trades if they reached a certain multiple of the entry price. And I did that to show the impact of implementing some sort of risk management approach, which should help limit significant drawdowns. Now, just to really quickly show you how the strike prices were selected for this strategy, I mentioned that I chose the delta to choose the specific put options that I was selling, and in this image I'm looking at the 16 delta SPX put option in the May expiration cycle, which as of this image has 38 days to go. And as we can see, the 2250 put has the delta of 0.16, and this is the 16 delta put. So when I say I'm selling put options based on the delta, this is exactly what I mean. So I'm using the delta to have a consistent approach for selecting the put options that I'm selling in this study. Here are the results for selling the 16 delta put options on SPY, which is the S&P 500 ETF from 2007 to 2020, based on the entry criteria that I had mentioned before. So as we can see here, from 2009 all the way until mid-2018, the strategy was pretty much flawless, and if you were looking at the historical performance of this strategy based on that time period, you would think that this is a pretty genius strategy and you basically can't lose. And the reason for that is because when you're selling put options, and especially a 16 delta put option, which is significantly out of the money, you are going to have profitable trades more often than not. And that's exactly what we can see here by looking at the cumulative profit and loss of this strategy over that time period. But of course, all things must come to an end, and unfortunately, we saw one of the most violent downside movements in the market that we've ever seen in history in regards to the magnitude of the move and the limited amount of time that it took for that move to occur. And as we can see here, the profitability of this strategy was disastrous going through that move in March of 2020. These results to me are extremely eye-opening because as we can see here, at the lowest point in March of 2020 during that sell-off, essentially 10 years of profitable trades were completely wiped out because the peak profitability of this strategy was just under $7,500. And we can see that at the lowest point in 2020, the strategy's overall profitability was just over $500. It was about $750 overall. So essentially 90% of this trading strategy's profitability was wiped out in one single trade, and that's because the market fell immensely in a very short period of time, and that means that the put that was sold had increased in price by a huge multiple, and obviously that's going to be very bad for put sellers. The strategy overall had an 83% success rate, meaning 83% of the trades were profitable at the time of closing them. The average profit was $91, but unfortunately the biggest loss on a closed trade was $2,215. Now, if we just eyeball the unrealized loss, the worst unrealized loss of this strategy, we can basically just take the high of 7,500, go to the low point of around 750, and we get a maximum loss of around $6,750 on one single trade, and that was in March of 2020. Before moving to the stop loss categories, I want to look at selling the 25 delta puts using the same exact first of month entries and exiting on the last day of the month and not using any stop losses. So as we can see here, it's essentially the same curve, but we can see by the cumulative P&L, this strategy had a higher net profitability at the highest point, as the cumulative profitability was just under $10,000 at the highest point. And that's because when you're selling 25 delta puts, you are going to be collecting additional premium compared to selling a 16 delta put, because 16 delta puts are further away from the stock price when you enter them, and options that are further away from the stock price will have lower premiums because they have a lower probability of being in the money at expiration. And therefore, when you're selling a 25 delta put, since you are selling a put with a strike price that's closer to the stock price, you will be collecting additional premium because that option has a higher probability of being in the money at expiration compared to the 16 delta put. This strategy had a 79% success rate, which was 4 percentage points lower than the 83% success rate we saw with the 16 delta put, but we can see that the average profit was higher at $143 a trade as compared to $91 a trade for the 16 delta short puts. The largest loss for the closed trades of the 25 delta short puts was $2,995, which is higher than the biggest loss for the 16 delta put, and that makes sense because the 25 delta put has a strike price closer to the stock price, so in the event of a market crash, that option is going to gain more value than the 16 delta put is going to gain on absolute dollar terms. So if we eyeball this, we can actually see that the peak to trough P&L from 9,500 to around 1,500 during that March trade, that's around an $8,000 unrealized loss. So compared to the 16 delta put that had an unrealized loss from peak to trough of about $6,750, the 25 delta put had a larger peak to trough loss of around $8,000. So now that we've looked at just selling put options and not managing the trades whatsoever, I want to go ahead and look at selling these same put options but implementing a 100% stop loss on the put option trades, which essentially means you close the trades if they double in value from the initial entry price that you sold the put for. So in this first test, we're looking at 16 delta short puts with a stop loss of 100%. Now what that means is that if I sell a put option for $2 in credit, and that put option rises to $400 or a 100% increase from the entry price, the trade was closed and a new trade was not entered until the next first of the month was hit, in which case the strategy was resumed. So the point of using a stop loss such as this one is to reduce the potential of extremely large drawdowns, and by adding a 100% stop loss, the strategy actually had a 70% success rate, so it was still over 50%. It was not the 83% success rate we saw when not managing the trades, but the average profit actually increased to $96 from $91, and the biggest loss dropped to $486 from around $2,200. So by implementing a simple stop loss strategy of simply closing the put option if the price increases a certain percentage against you, you significantly limited your drawdowns and you did not experience a scenario where you saw 10 years of profitability wiped out in one single trade. Of course, when you take losses, you eliminate the possibility of seeing your losing trade turn into a winning trade, which is something that we all suffer from psychologically. But by taking the safe route and closing the losing trade and not allowing that trade to potentially turn into 1,000 or 10,000% loss relative to the premium that you received, you can eliminate those huge drawdowns and you can move forward to the next trade and you can keep your risk in check. Of course, when you're taking a stop loss, we can see that the overall profitability of this strategy was not the initial $7,500 that we saw when selling the 16 delta puts and not taking any stop loss. And we can see that this strategy had a high point of around $4,000, which is half as much, but at the end of the day, we could have doubled the size of this strategy and sold 2 contracts instead of 1 contract, and it would have been essentially at the same spot, but without those disastrous drawdowns that we saw in March of 2020. In other words, if you can implement sound risk management in your options trading strategies or stock trading strategies or whatever you're trading, you can increase your size, and that is going to essentially get rid of the problem of having reduced profitability in favor of risk management. So basically what I'm saying is that you can sell 2 of these put contracts and limit your losses by using a pretty tight stop loss, and that is going to be better, in my opinion, than selling 1 contract and having no risk management whatsoever. When we look at selling the 25 delta puts with that same 100% stop loss, we see the same exact cleanup in this profitability curve as we've eliminated those catastrophic losses from the March 2020 market crash. So in this case, again, I'm using a 100% stop loss, which means if I sold a put for $2.50, I'm closing that put if it increases to a value of $5, which means it has increased 100% from the initial entry price of $2.50. Now still, this strategy had a 70% success rate, and the average profit was $148, with the biggest loss being $695. So again, we noticed a small increase in the average profit per trade and a significant reduction in the biggest loss, because this trade previously had a biggest loss of $3,000, but when implementing the 100% stop loss strategy, the biggest loss is knocked down to just under $700. And the average profit, as I mentioned, actually went from $143 to $148, and the average profit was able to increase because we got rid of a lot of those huge losses that dragged down the average P&L in the previous category. They say selling deep out of the money options is like picking pennies up in front of a steamroller, and I hope that this study showed you exactly why people say that, and that's because you can make money most of the time as the market rarely falls drastically, which means that selling put options against a index like the S&P 500 historically is going to be a very favorable strategy, and even going forward, it's going to be a very favorable strategy most of the time. But what you really want to watch out for is the market periods like March of 2020 or August 2015, where we saw a very violent downturn in a very short period of time, because those are the types of market movements that are going to bode very, very poorly for short option traders, particularly short put traders. The coronavirus-induced stock market crash of March 2020 was the steamroller that wiped out essentially years of profitable short put trades, and if we take the unrealized loss from that worst point in the March 2020 trade, we saw that in both cases, essentially 10 years of profitable trades were wiped out, and that is not a sound trading strategy whatsoever. The next time you look at far out of the money options and think that they're free money to sell, think very carefully before actually selling, and that's essentially why I made this video and did this study. I've been looking at the results for selling S&P 500 put options for years, and prior to March 2020, without that huge market crash, all I saw was that selling index puts was very, very profitable, and the profitability line is essentially a 45-degree angle, meaning that every single month the strategy makes money, and it seemed like a genius strategy. But the March 2020 market crash showed why it's so dangerous to sell index puts without any protection or without any risk management whatsoever. So if you do go out there and you're selling naked put options in stocks or a stock market index, Just make sure that you understand what can go wrong, and I hope that this video showed you exactly what can go wrong, and it nudges you into a direction of being more careful and perhaps implementing some risk management strategies, as I've discussed in this video. In the case of selling out of the money index puts, you are selling catastrophe insurance at the end of the day, and when catastrophe strikes, as the insurance seller, you are going to have to pay up. Now, the bigger the catastrophe, the more you are going to have to pay up. And you should also keep in mind that the people who are buying those put options are large institutions or traders that have large long stock portfolios, and those people buy index put options for the exact reason that we saw earlier, and that's because if the market falls dramatically, those put options are going to increase in value substantially. And if a portfolio manager uses 10 or 1% of their portfolio and they buy those put options, and those put options increase 15 times in value, then that's going to result in a 15% gain on their entire portfolio, and that is going to shelter the losses from the long stock. Now, I am not suggesting that selling put options should be avoided entirely, and I'm not saying it's an evil strategy, but I am suggesting that if you do sell naked options, particularly naked put options against a stock market index that usually grinds higher, but then when it goes down with velocity, it's highly necessary to use aggressive risk management and or loss taking strategies when you are implementing such a strategy, because your loss potential is significantly more than what you can make, and the number one thing that you need to focus on is limiting the potential losses that you incur in your account. What option selling strategies have in common is that they have high loss potential and limited reward, and as I mentioned, losses must be mitigated in some way for option selling strategies to be net profitable over the long term. So as I said many times in this video, prior to that March 2020 drawdown, selling index put options looked like a genius strategy because it made money consistently month in and month out for 10 straight years. But then all of a sudden, one single trade wiped out essentially all of the profits from that strategy, and that is obviously not a sound trading strategy long term. So if you're implementing a strategy such as selling naked put options against an index, you have to have some sort of loss management strategy in order to protect yourself from those huge losses that are inevitable over a long period of time. The last thing I want to touch on in this video is that the probability of making money on a given options trade does not inherently make it a good or bad trade. Both put selling strategies in this study initially had a 70 to 83% success rate, but the no management approaches had unrealized drawdowns that wiped out essentially 10 years of profitable trades. So if we look at these trading strategies and say that they are great strategies because they make money 70 to 83% of the time, we're missing the point. In options trading, the probability of making money on any given options trade is relative to the risk and the reward. So when you're selling put options, you have limited reward and you have substantial risk, as we've seen, and because of that, you are going to have a high probability of profit on that strategy. Something like buying call options or buying put options, those strategies have limited risk and immense profit potential, and because of that, they have a low probability of making money. So a trade is not bad or good because it has X% probability of making money, because at the end of the day, risk management matters, and as we've seen here, when you're selling put options, you could have an 85% success rate, but all it takes is one bad trade to wipe out 10 years of profitability, as we've seen, and in that case, your 85% success rate doesn't really mean anything at the end of the day. Thanks so much for watching this video, everybody. I really hope you enjoyed it. Please feel free to leave me a comment down below if you have any questions or want to leave some feedback. And you can also check the link in the description for additional resources. I'm Chris from Project Option, and I will see you in the next video.